Have you ever wondered why gold and silver prices sometimes move in ways that don't make sense? Why one day silver might seem impossible to buy, or gold suddenly shoots up without warning? The truth is, the precious metals market is full of hidden moves, technical problems, and big decisions that most people never hear about. For instance, sometimes contracts that traders hold can suddenly be declared invalid. This isn't a small detail. It can shake the market and change prices almost instantly. Imagine a market that's been around for decades, yet suddenly, a large chunk of it collapses because there isn't enough metal to back the contracts. It's a situation where no one can really make money because the supply simply isn't there. Right now, the way gold and silver are priced is changing. Prices are increasingly being set in places like Shanghai rather than traditional Western markets. This shift isn't random. It's part of a larger story involving international trade, currency systems, and even geopolitical conflicts. When nations go to war or run huge deficits, it's not just news headlines. It directly affects gold. Wars are often bullish for gold, not because of the conflict itself, but because governments need to finance these wars. Printing more money to fund military operations creates inflation, and inflation historically pushes gold prices higher. Even outside of wars, rising deficits and economic weakness contribute to this effect. Countries may already be rolling over large amounts of debt, and as interest rates rise, the need for liquidity and safe stores of value increases. This is where gold and silver step in. Unlike paper currencies, they hold tangible value and act as a hedge against inflation. Investors naturally flock to these metals when the economy shows signs of stress. Another key factor driving gold and silver markets today is how international exchanges handle the metals. In Asia, particularly China, the Shanghai Gold Exchange has developed mechanisms that allow gold to be exchanged for local currency, such as the yuan. This means investors can deposit gold and get paid in currency, or deposit currency and withdraw physical metal. It's a gold for yuan exchange, which strengthens trust in the system and even sets the stage for China to eventually fix a formal gold-yuan conversion rate. If this happens, it could anchor their currency to a tangible asset, giving nations around the world an alternative to relying solely on the dollar. At the same time, silver is becoming an increasingly strategic commodity. When certain nations, wary of losing control over essential resources, limit silver exports, it impacts global availability. Recently, new licensing rules and export restrictions have reduced the flow of silver to Western markets. This isn't just about economics, it's geopolitical. By controlling supply, nations can protect their industries and even use critical metals as leverage in international negotiations. So, what does this mean for investors like you? Physical supply is now shifting toward Asia, especially China, which could increasingly influence global prices. Prices in Shanghai or Hong Kong may rise above those in London or New York, partly due to taxes on imports and shipping costs, creating arbitrage challenges. This fragmentation means traditional Western markets may not fully reflect the actual market value of gold and silver anymore. Understanding this shift is key if you want to position yourself wisely for potential gains. Stay tuned, because in the next part, we'll dive deeper into how these changes in silver supply, global demand, and market mechanics are driving opportunities and risks for traders and investors alike. For the latest insights and analysis on gold and silver, make sure you're following Gold Silver Scope, where we break down these complex markets into clear, actionable insights. One of the biggest stories in the silver market today is the shrinking supply of physical silver, especially in Western exchanges like COMEX and London. Reports show that the amount of silver available for delivery is falling at a rapid pace. For example, registered silver at COMEX has dropped to levels not seen in decades, with only about 86 million ounces available. That's roughly 17,000 contracts, and it's a clear sign that the market is under stress. When supply is this tight, speculative traders often avoid holding positions because the risk is too high. Open interest, the number of active contracts, has recently fallen to its lowest in 20 years. This is a strong indicator that the market is moving away from paper speculation and increasingly being driven by real physical demand. At the same time, the Shanghai and Hong Kong exchanges are becoming the main centers where prices are effectively set. The cost of importing silver into China includes a 13% VAT, which adds a significant layer to the price. This makes arbitrage between markets more complicated and costly, creating a scenario where Shanghai prices can run well above those in Western markets. Traders in Europe or the US can no longer rely on simple cross-market strategies to profit because the real supply is physically moving eastward. Essentially, Asia is starting to dictate the actual price of silver and gold. This shift isn't only about supply and taxes. It's also about strategic control. Countries like China have started to limit exports of silver and other critical metals. When they reduce the flow of silver to the West, it's not random. It's a deliberate move to protect their own industries and prevent rivals from stockpiling resources. Silver, like gold, is more than just an investment. It's a strategic asset. By controlling its supply, countries can influence markets, protect economic interests, and even leverage negotiations in geopolitical disputes. Another important point is how wars and government spending affect metals. For example, when governments fund large-scale conflicts, they often print more money or run bigger deficits. This increases inflation, which tends to push gold and silver prices higher. Investors notice this pattern and respond by moving money into tangible assets. The recent geopolitical events and conflicts are creating exactly this kind of environment. With rising bond yields and weaker economies, inflation becomes almost inevitable, and hard assets like gold and silver become increasingly attractive. Meanwhile, bullion banks and market makers in Western markets are trying to exit contracts without taking huge losses. This creates technical problems where contracts are declared invalid, markets halt temporarily, and prices move unpredictably. The result is a chaotic situation where traditional markets are no longer the main price drivers. Physical demand, supply chains, and Asian exchanges are becoming the true influencers of the market. Traders who understand this shift can position themselves strategically, while those who ignore it risk being caught off guard. In short, the silver market is undergoing a significant transformation. Physical supply is declining in the West. Strategic control is rising in the East, and traditional paper markets are losing their influence. Understanding these dynamics is essential for anyone looking to invest in or trade gold and silver today. Gold is not just another investment, it's a safe haven, especially when uncertainty rises. Right now, global events are creating the perfect storm for gold. Wars, government spending, and economic weakness all play a role. Interestingly, gold often rises not because of the fighting itself, but because of how governments pay for these conflicts. When a country goes to war, it needs enormous amounts of money. Raising taxes on citizens is usually unpopular, so governments instead run bigger deficits or print more money. This increases inflation, which makes gold more valuable as a store of wealth. Even without wars, economies are facing challenges. Rising interest rates, debt rollovers, and slowing growth put pressure on currencies. Investors naturally turn to gold as protection. In this context, gold becomes more than a commodity. It's a hedge against inflation, a way to preserve purchasing power when paper money loses value. With rising deficits and global uncertainty, demand for gold is likely to remain strong. The connection between war and gold is clear in historical trends. When governments spend heavily on defense, energy, and rebuilding efforts, the economy often slows and inflation rises. For example, military conflicts require purchasing massive amounts of equipment, weapons, and energy. Once used, these items need to be replaced, which fuels additional demand. As governments borrow more to fund these efforts, the money supply expands. Gold benefits because it holds value when currencies are diluted. Another factor is the weakening of the US dollar during these periods. When deficits grow and inflation rises, the dollar's purchasing power decreases. This is bearish for the dollar, but bullish for gold. Investors around the world start looking for assets that are not tied to a single currency, and gold is the obvious choice. Its value is recognized globally, making it a safe haven during periods of economic uncertainty. Silver also reacts similarly to gold, but with additional dynamics: supply shortages, export restrictions, and strategic stockpiling by countries like China make silver a unique play. As physical silver becomes harder to acquire, prices can spike, especially when demand is high. Investors who monitor these supply trends alongside gold movements can make informed decisions and potentially benefit from both metals. Finally, it's important to understand that markets are shifting eastward. China, through exchanges like Shanghai, is increasingly influencing gold and silver prices. Physical markets in Asia often trade at higher prices than Western paper markets. This shows a shift in pricing power. Investors who understand this trend can position themselves strategically, while those relying solely on Western exchanges might miss the real market signals. In summary, gold is bullish because of inflation, deficits, and uncertainty. Wars amplify these factors, making gold a safe haven. Silver is also under pressure due to supply shortages and strategic controls. Understanding these dynamics is critical for anyone looking to protect wealth or profit in the precious metals markets today. The precious metals market today is complex, and it's not always obvious how prices are determined. In Western exchanges like COMEX, technical problems and market manipulation often play a major role. For example, when supply is low, bullion banks and market makers may try to exit contracts without losing huge amounts of money. This can result in large numbers of contracts being declared invalid or markets temporarily halting trading. Such disruptions show that traditional paper markets are struggling to reflect real-world supply and demand. One striking trend is that open interest, the number of active contracts in silver, has fallen to levels not seen in decades. This suggests that speculation is decreasing and physical demand is increasingly driving prices. Traders in the West face challenges because arbitrage between markets is costly. For instance, importing silver into China includes a 13% VAT on top of shipping fees. This makes it much more expensive to move silver between Western and Asian markets. As a result, prices in Shanghai or Hong Kong can be significantly higher than those in London or New York. This shift in pricing power has important implications. Physical metals are moving eastward, and Asian exchanges are becoming the true influencers of the global market. Western paper markets, which once set the standard, now play a secondary role. For investors, this means understanding where the actual demand and supply are is crucial. Following only Western prices can give a distorted view of the market. The rise of Asia in setting prices is also tied to strategic and geopolitical factors. Countries like China control exports of silver and other critical metals, limiting availability to the West. This strengthens their own industries while preventing rivals from building stockpiles. By controlling supply, these nations gain economic leverage and can influence global markets indirectly. This is not manipulation in the illegal sense. It's strategic resource management. Meanwhile, gold's story is slightly different but connected. Wars, inflation, and deficits drive demand for gold, while global uncertainty pushes investors toward tangible assets. The combination of rising deficits, weak economies, and geopolitical risks creates a powerful environment for gold and silver. Investors who understand these dynamics can position themselves to benefit from both metals, while those who ignore them risk missing key market signals. In addition, recent market disruptions highlight the importance of physical ownership. When contracts fail or exchanges temporarily close, only those holding actual metal remain fully protected. This emphasizes the need for a diversified approach. Paper trading alone may no longer guarantee exposure to real-world value. In short, the precious metals market is undergoing a major transformation. Paper markets in the West are increasingly influenced by physical markets in Asia. Supply, strategic control, and global demand are shaping prices more than speculation. Understanding these mechanics is critical for anyone aiming to make informed investment decisions in gold and silver today. Now that we understand the bigger picture, it's clear that gold and silver are poised for significant moves. Physical supply is shifting eastward. Asian exchanges are gaining pricing power, and Western paper markets are losing influence. At the same time, inflation, deficits, and geopolitical tensions are creating a bullish environment for both metals. For investors, this means one thing: it's time to think strategically about positioning in these markets. One key takeaway is the importance of timing. When markets are volatile and supply is tight, waiting too long can result in missed opportunities. For example, physical gold and silver may rise quickly once global awareness of these shifts spreads. Historically, periods of uncertainty, wars, rising deficits, or inflation spikes have been followed by rapid increases in precious metal prices. Investors who act proactively rather than reactively tend to benefit the most. Diversification is another important strategy. While gold is often the primary safe haven asset, silver offers unique opportunities due to its industrial demand and supply constraints. Physical ownership, bars, coins, or allocated storage provides direct exposure to the metals, protecting against market disruptions or technical failures in paper contracts. Keeping a balance between gold and silver allows investors to capture gains in both while mitigating risk. It's also critical to stay informed. Asian markets, particularly Shanghai and Hong Kong, are becoming central to price discovery. Understanding where supply is moving and how local policies affect exports can give investors an edge. Following these developments closely helps in making timely decisions and avoiding pitfalls in fragmented global markets. If you're ready to take your knowledge further, start by analyzing physical supply trends, monitor international exchanges, and watch for geopolitical or economic events that could influence prices. Small, consistent actions now, like buying physical metal gradually, can yield significant benefits over time. Remember, patience and preparation are key. For more updates, insights, and clear analysis on gold and silver markets, make sure to follow Gold Silver Scope. Here, we break down complex market trends into simple, actionable insights, so you always know where the opportunities are.